Hey everyone, and welcome back to another video for today, or should I say another therapy session. Usually we do this also during the live streams, but today were some other priorities. So what you're seeing here today is the performance of the week. So a lot of stocks that we do follow and cover are red, right? Down 5%, 6%, 3%, etc., etc. During the day, Friday, pre-market, we were down quite a lot. Then the market opened and actually a lot of stocks started to recover. Now, what's the reason behind the panic over the last couple of days? Maybe I should say panic, because let's face it, we're still 2-3% from the all-time highs for the markets? Of course, when you look at specific names, some names are already down 10, 15, maybe even 20% from their recent highs. Some other names, like Google, for example, are making all-time highs. So what's going on right now? What am I doing? We're going to touch on all of that in this video. Hit all the buttons, would really appreciate that. If you want to support me even further, do check out the link down in the description and in the pinned comment to the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So first order of business, we've had this Zions Bank Corporation and Western Alliance Bancorp. One stock fell 12% after they announced an unexpected $50 million loss from a single problematic loan. The other, their shares dropped over 10% after they revealed they are suing a borrower for fraud. Then we've also had JP Morgan CEO Jamie Dimon come out and say the following thing: when you see one cockroach, there are probably more. Meaning when you see one bad lender, one of those bad names out there, there might be more. And so the market started to panic a little bit. A couple of other things here. The prolonged period of high rates is squeezing some companies, increasing the risk of default across the board, especially in the shaky commercial real estate sector, where regional banks are heavily exposed. We've seen high-profile bankruptcies recently, like auto parts supplier First Brand. The big problem there was the alleged use of the same collateral with multiple lenders, a scary indicator of poor underwriting in the unregulated private credit space. The Western Alliance news amplified the fear that the quality of corporate credit may be weaker than the official data suggests, meaning banks might have to set aside more money for bad loans. Now, the thing here is that the issue so far is, again, so far, we're talking here about regional banks. Because if we go and look at the big banks, because luckily for us, JP Morgan, Goldman, BlackRock, Citi, Wells Fargo, and today we've had American Express, Ali, all of them reported already over the last couple of days. And guess what? All of these reports were quite good. I think across the board we've had beats as well. Commentary on credit was also a bit more positive. But yeah, here we're talking here about regional banks. And so if it turns out, because so far it's a handful of names, but if it turns out that a lot of regional banks have issues, then of course the problem might be bigger than what we thought. And that's basically what Jamie Dimon here says. When you see one cockroach, there are probably more. Now, if we go and read some of the comments from the CFOs of JP Morgan, Bank of America, we have here a nice summary from Brad, Stock Market Nerd, on X. So first up, we have here the JP Morgan CFO. The current facts on the consumer side are that the consumer is resilient, spending is strong, and delinquency rates are actually coming in below expectations. Bank of America. Asset quality remains sound, focusing on total net charge-offs in the near term. We would not expect much change in total net charge-offs given the steady consumer delinquency trends and reduction in CRE exposures. In addition to improving consumer losses, note the reductions in both reservable, criticized, and NPL metrics for the commercial portfolio. Citi. The macro environment reflects more global resilience than many anticipated. The US continues to be a pace setter driven by consistent consumer spending as well as tech investments. While growth is cooling somewhat and we're keeping an eye on the labor market, America's economic engine is indeed still humming. And it's worth noting that across our US cards portfolios, delinquency and NCO net charge-offs rate continue to perform in line with our expectations. Wells Fargo. Credit performance remained strong and continued to improve. Commercial net loan charge-offs were stable from the second quarter with lower losses in our commercial and industrial loan portfolio, largely offset by higher commercial real estate losses. Again, that has been an issue like we've talked about before. Consumers continue to be resilient as income growth has generally kept pace with increases in inflation and debt levels. And of course, we also know that rate cuts are coming, right? I mean, rate cuts are here. We're expecting another rate cut at the end of October and then another one in December, which should of course help with this current scenario. Then we've had the American Express and Ali report on Friday. American Express said the following thing: credit metrics remain within expectations despite higher loan growth, while revenue and earnings guidance both move higher on strong engagement and demand. As for Ali, results reflected continued stability in credit trends and disciplined deposit management. While retail auto margins remain under pressure, strong credit performance and expanding deposit base underpin our solid balance sheet. So again, so far, the fears are, in my opinion, overblown. But okay, in these types of scenarios, I guess it's fine to be more prudent than to just say, it's nothing. Because we know what has happened, right? 2007, 2008, when everybody was maybe not paying attention, was not as, let's say, informed as we are today. We've got a great financial crisis. I think we're very, very far away from having another '08, and this is also not something like we've seen in 2023. It's something to keep an eye on, but right now, from all of the big players and all of the other players that we've seen report in the last couple of days, seems like it is an isolated event. And when we talk about SoFi, for example, I think SoFi is in a very, very good place right now. Pagaya, same thing. I think Upstart should be fine here as well. But of course, it's great that we have the earnings season, because every single week we will get more and more information from different companies in different industries. And so you will set all of your puzzle pieces into one big puzzle and get your beautiful picture. Now, talking specifically about your stocks, the stocks that we own, the stocks that you own, if you ask yourself the questions, right? We've got here a couple of questions, as always, therapy session. Why is your stock down, right? You have to ask yourself that question if you really care, right? Is it macro related? Is it company specific issues? Or maybe is it industry related, right? Because if it's macro related, then maybe you're not directly affected. It's just the whole market overreacting or the whole market bringing everything down. Opportunity. Company specific issues. Yes, if the company maybe lowered their own guidance, okay, that might change things. Maybe there are some other issues inside the company. That's a bit different. And then the last one here, industry related. Maybe this is a problem in this case here, lenders, right? Subprime lenders, maybe regional banks. So industry related, financials, fintech. Is it directly impacting your stock or your company? Remains to be seen, right? This was the prime example here is like Snapchat. Remember when Snapchat reported before Meta and Google? Of course, they reported bad earnings, and that brought down the likes of Meta, the likes of Google, the likes of Trade Desk as well. But what happened a day later or a week later when these great companies reported? Turns out that, well, you cannot compare both companies because Meta, Google, the Trade Desk, they were all reporting incredible quarters. And then, of course, their stock did recover. In this case, yes, it is an opportunity when the stock is down because it's unrelated to the company itself. Then, have I set realistic expectations? This is extremely important, especially right now because we've seen plenty of stocks go up 5x, 3x, maybe even 10x over the last 6 months or so, or maybe year to date. I've seen some posts on X saying, some of the stocks, they're down because, well, it's unrelated to the company, like we've just discussed right now. But then I was like, but a lot of these stocks have 3x, 5x, 10x, and fundamentally nothing has changed with the company itself, right? There are some high-flying names, whether it's the AI cloud names, quantum computing names, or whatever. There are a lot of these names where, the price has gone up a lot because maybe re-rating, maybe because the business fundamentally did change, or in a lot of cases, it's based on hopium. It's based on future expectations. It's based on, if this company had this deal with that amount, then maybe that company would also get that deal. But that's usually not how it works, right? Because imagine if that company doesn't get the same deal, the same amount of contracted revenue, right? Then, yes, your stock that has gone up 2x, 3x, 5x, 10x will come crashing down because it has gone up based on fugazi. It's a wazi, it's a woozy, it's fairy dust. Lastly, why do I feel uncomfortable when the market is volatile? Right? Why do we feel uncomfortable when the market is volatile? Is it because one, we don't know what we own? Two, we don't like to see our paper gains disappear? Or three, maybe we don't have the cash to add during those days. Maybe it's all of the above. Who knows? But when you start answering, or when you're able to answer all of these questions every single time in an, let's say, organized way, then you will feel way more comfortable in these types of environments, right? We've known. September was supposed to be a bad month, was a good month. October is supposed to be the most volatile month. Turns out to be true so far. The VIX has gone up until I think 26 or so. It's been as high as May. Usually that is, yes, a buying opportunity. Plus, I do also think that getting a small flush out here before big tech reports, before a lot of companies do report their quarterly figures, is a good thing, right? Because you're getting basically the expectations are going a bit lower, going into the earnings season, going into the earnings reports. Then you get maybe bad results. Okay, stock can take a bigger hit, maybe, or maybe not, because the stock has already come down a little bit. Or if it's a good result, then yes, the stock will continue to go up because the company is showing you why you are paying up to own these types of companies. Yes, we've seen the scenarios where beats across the board, stock is down. It might be that the stock was priced to perfection. That's why having a small pullback before earnings season, to me, is quite good. You lower the expectations of the market and you let the company do its thing. Now, going back actually to this question right here, specifically talking about all of these Bitcoin miners turning into AI cloud players. I've had a small back and forth with someone on X, and it's true, a lot of people have set unrealistic expectations. Right? I'll give an example of a company that I own, specifically Iron, but you can apply this to all the others out there as well. Yes, 2.9 gigawatts. Okay, that's cool. You've got the land, you've got contracted, connected energy, right? 2.9 gigawatts, maybe more on the way. That's great. But I gave the example of, okay, I own the land, I own a zoo, right? An example. I own the land, I own the zoo. But the zoo has no animals. What's the point, right? What's the point of having a zoo without any animals? Then, let's say the zoo owner, me here in my case, I am saying, okay, I've got the land, I've got the zoo, and now I am expecting the animals to fall from the skies. In this case, the animals are the GPUs, right? Because it's great to have land and connected energy or potential connected energy, contracted energy, whatever you want to call it. It's great, but you need the GPUs. You need to build. You need to make sure that everything is connected. You need to make sure that the bandwidth is good, right? Everything's up to speed. Everything is super competitive. A lot of times what I'm hearing is, 2.9 gigawatts equals, I'm just throwing out a number, $20 billion. Because Oracle did this and CoreWeave did that and Nebius got this. But no, there are a lot of other costs associated to reaching $20 billion in revenue, right? I've made the video. How are we going to reach 26, 27, 28 billion dollars in revenue? We need, in this case, Iron needs a hell of a lot more GPUs, right? In the millions, actually. I think it was 1.9 million GPUs or something like that. Of course, again, that number can fluctuate, and it's not just Iron, it's all the rest as well. If you want to generate a lot of revenue, there are, of course, a lot of costs associated to it. Unless you do have co-location deals, right? Or co-financing deals where a player comes in, they've got all of the GPUs, and then, yes, you provide all the rest. But all the rest is not free, right? All the rest will also cost you money. That's why it's important to read what's inside those deals. That's also why Iron's leadership have always said, look, we're looking right? We're looking for colocation deals, but it has to make sense for us. Return on investment wise, margin wise, it has to make sense. So again, set realistic expectations, not just for the irons out there or the, I don't know, CleanSpark or you name it, but for every other company that I own or that you own as well. Because if you set unrealistic expectations, then you are bound to get burnt. Lastly here, at the time of making this video, this is basically it, the amount of players that are red and green on the watch list. We opened up the day where everything was basically red. Right now, the only names that are green, surprise, surprise, is Intel, New Holdings, Shift4, and PayPal is up 0.2%. Duolingo is down 0.2 or here or so. The rest here, Nebius, for example, is down 7.7%, Iron down 4%, BMNR down 4% here as well. Oscar back under $20, down 7.6%. Very, very volatile name more recently. HIMS is down 11% or so. This is basically what we got right now. Let's maybe quickly check Mercado Libre. Mercado Libre is again here around $2,000. Again, a lot of these names have no connection directly, of course, with what's going on, bad lenders, regional banks, etc., etc. But of course, if some of these banks do explode, then it does have an economic impact, which then will indirectly impact a lot of the other stocks out there. And so all in all, to conclude, opportunities, right? Volatile times are always good to find opportunities. Then going into this earnings season, you'll see that the good companies will continue to report good numbers. Maybe some of them are priced to perfection, some of them are not. And then you'll see bad companies, which are super overvalued, overextended. They'll report meh earnings, stock goes down, we'll have a rebalancing, and things, well, over the long term, you'll see that what matters is fundamentally good business. What doesn't matter is hype and hopium. And so that's about it for me in this video. I did add a little bit more to Nebius and to SoFi. Yes, believe it or not, even if those are two big positions for me, I don't care. I am averaging up and I'm continuing to accumulate more shares of good companies. You're going to ask me, oh, but why didn't you add to this company? Why didn't you add to that company? Well, I am building up Shift4 and Rubrik as well, but I already added to them a couple of days ago. I'll be adding to other positions in due time. I have the cash, I have the time. That's all I need. That's all I need. So all in all, that's about it for me in this video. Let me know what you think down in the comment section below. Like, subscribe to all of that, and I'll see you all in the next one. Bye-bye.